Central banks have been buying gold for 16 consecutive months. The silver deficit in physical markets is real and documented. Geopolitical tension in the Middle East isn't going away. Every structural argument you've heard for owning precious metals, it's all still true today. And yet, gold is down. Silver is getting hit nearly 4 times harder. That's the thing nobody stops to explain properly. The long-term thesis hasn't cracked, not even close. But if you walked into today's session leaning on that thesis, you've been losing money since the open. There's a reason for that, a specific, identifiable reason, and it has almost nothing to do with any of those big structural stories. One number is running today's session. Everything else is noise. The dollar index, DXY, is sitting at 100, up roughly 0.25% on the day. That sounds modest. In practice, it's enough to override almost every other factor in the room. Here's the mechanics. Gold and silver are priced in dollars. When the dollar strengthens, the purchasing power of foreign buyers falls in real terms, which compresses demand, which pressures price. This isn't sentiment or narrative, it's arithmetic. It happens fast, and it happens consistently. Now consider the context around that number. There is no high-impact macro data today. No CPI, no PPI, no PCE, no jobs report. The next genuine catalyst on the calendar is the FOMC meeting on March 17th and 18th. That's days away. In the absence of competing data, DXY doesn't share the stage. It becomes the session. That's the environment we're trading in. A moderate dollar bid, no macro event to disrupt it, and metals repricing accordingly. What's worth noting, and this matters for how much pressure is actually warranted, is that DXY at 100 is not DXY at 105. The move is real, the direction is clear, but we're not in a panic dollar bid. The pressure on metals is proportional. Which means the setups, when they appear, are measured. Not a rout, not a collapse. A controlled drift with identifiable levels. The dollar explains why metals are down. It doesn't explain the second thing that needs explaining, which is why silver is getting hit so much harder than gold. Gold is off roughly 0.6%. Silver is down somewhere between 2.5 and 3.5%. That gap isn't random. It's structural, and it shows up reliably under these conditions. Silver carries a dual identity. It functions as a monetary asset, a store of value, a hedge, the same category as gold. And simultaneously, it's an industrial metal. Solar panels, electric vehicles, electronics. That second identity is the one that makes it asymmetric. When the dollar strengthens and risk sentiment softens, both identities get hit at once. The monetary leg sells off alongside gold. The industrial leg sells off on implied growth concerns. Softer macro, softer industrial demand. Gold doesn't have an industrial leg. So gold absorbs one source of selling pressure, silver absorbs 2. You can see this in the gold-silver ratio, which is expanding today. That ratio widening is a confirmation signal. It tells you the asymmetry is live, that this isn't a random divergence. When conditions reverse, silver tends to snap back harder for the same reason. That's the long-term case. But right now, the expanding ratio is not a buying signal. It's a warning that silver will keep underperforming gold until the macro backdrop shifts. One more factor capping silver specifically. COMEX registered inventories are sitting around 78.6 million ounces. Stable, not in shortage. The physical market is tight, yes, but tight is different from crisis. And with prices elevated, there's meaningful substitution risk in the industrial sector. Solar manufacturers have price sensitivity. High silver prices have historically pushed engineers toward thinner applications or alternative materials. That doesn't break the long-term demand story, but it takes some pressure off the upside argument for today. Here's a question worth sitting with. Which narrative have you been running? The silver deficit thesis or today's intraday reality? Both can be true. The mistake isn't holding the long-term view. The mistake is trading off it on a day when it's not the active driver. With the why established, here are the levels that matter. For gold, GC, The pivot sits around 5,100. Resistance clusters between 5,110 and 5,125, which is where VWAP and the first daily resistance level converge. Stronger resistance above that at 5,140 to 5,150. On the downside, the first meaningful support is 5,070 to 5,080. This is a high-volume node, meaning real buying has occurred here previously. Below that, 5,050, then 5,025. For silver, SI, pivot at roughly 82.50. VWAP resistance in the 83.50 to 84.20 range, with 85.00 above that. Support at 81.80 to 82.00, then the more significant level at 80.80, and below that, 79.50. A volume profile low where price has found actual buyers in the past. On a day with no macro catalyst, VWAP becomes a gravitational center. In a session where the directional bias is already established, dollar firm, metals offered, price tends to rally toward VWAP and fail. Not always, but enough that the structure is useful. A rally into VWAP resistance in a downtrend is not a "the bottom is in" signal. It's a retest. Treat it accordingly. Also flag the 9:30 Eastern Open. Even on a light data day, the New York Open introduces new participants, new order flow, and occasional sharp moves on secondary data, import prices, regional Fed surveys, that don't make the high-impact calendar but can still generate noise. The safest window to avoid holding through is roughly 8:30 to 10 Eastern. The primary setup for both instruments is short, but the framing matters. This is not "the market is going down, sell it." That's a thesis trade, and thesis trades entered at random points are how people give money back. The setup is price rallies to resistance in a downtrend, shows rejection, then offers a defined entry. That's a different trade. It has structure. It has a clear invalidation level. It respects the difference between direction and timing. For gold, watch for a rally into 5,110 to 5,125. That's VWAP or R1, whichever is in play. If price gets there and stalls, that's your moment. First target is 5,070 to 5,080. Second target is 5,040 to 5,050. Stop above 5,145. Risk on the trade is roughly $15 to $20 per contract, which at proper sizing keeps you well within a manageable loss. For silver, same logic. Wait for the rally into 83.50 to 84.20 or VWAP. Rejection is the entry signal. First target at 82.00, second at 80.80 to 81.00. Third at 79.50 if momentum carries. Stop at 84.80. Silver is the more aggressive instrument. It moves faster in both directions, so size accordingly. There is a contrarian long scenario. DXY breaks and holds below 99.80, geopolitical headlines escalate in a way that reignites safe haven flows, and GDX or SIL confirm with strength. In that case, the long back toward resistance becomes live. But be honest about the probability weight. That scenario is running at roughly 20%. Don't force it. One more for the nimble. Scalps around VWAP on the 15 or 30-minute chart work well for both metals in this kind of session, particularly in the pre-NY window. Small targets, tight stops, don't overstay. Now, scenario question, and answer it honestly before you put on a position. If DXY pushes through 100.20 and holds, what do you do? The answer isn't automatic. It depends on whether you're already in a short, whether you have room to add, and whether the level holds on a retest. The value isn't the answer. The value is having thought through the conditional before the market forces you to think fast. The setup quality is irrelevant if the sizing is wrong. One undisciplined position can make a correct read into a losing day. Max risk per trade, 0.75% of capital. Minimum reward to risk of 1 to 2.5. Meaning, if you're risking $500, you're not taking the trade unless the target is at least $1,250. For an account of $50,000 or more, 1 to 2 contracts in gold, 1 contract in silver. One thing that gets missed, GC and SI are running a correlation of roughly 0.85 to 0.9 today. Holding meaningful size in both simultaneously is not diversification, it's concentration with extra steps. Pick the instrument that gives you the cleaner setup, size it properly, and manage one position well rather than 2 positions roughly. The DXY threshold worth tracking, 100.20. If it breaks above that level and holds, that's not just confirmation of the directional bias, it's a signal to increase short exposure within your risk parameters. Not a reflex, a considered addition with room in the book. Before you look at any of these setups, one question worth having a real answer to. What's your maximum loss for today? Not per trade, for the entire session. If that number doesn't exist, today's analysis is noise. Base case, 70%. DXY holds above 100. No macro surprise, metals drift lower through the session. Gold works toward 5,040. Silver toward 80.80. This is the trend continuation environment. Patient, selective, waiting for the rally to resistance before entry. No chasing, no guessing bottoms. Bullish reversal, 20%. DXY retreats below 99.80. Something escalates in the Middle East in a way that pushes safe haven flows back in. GDX and SIL confirm with a turn. In that case, the short thesis is wrong for today, and the long back toward resistance becomes the trade. But this scenario requires all 3 conditions, not 1, not 2, all 3. Don't half trigger it. Range day, 10%. No directional conviction either way. Price chops between 5,070 and 5,125 on gold, 81.80 and 83.50 on silver. This is the most dangerous session type for directional traders, and the hardest to recognize early. The tell is usually multiple failed breakouts in both directions within the first hour of the NY session. If that's what you're seeing, the right response is to step back, not to trade faster. One thing worth stating clearly, the structural thesis for precious metals is intact. Central bank accumulation, China now in its 16th consecutive month of buying, Polish reserves building, others following. The physical silver market remains tight. Geopolitical pressure is structural, not episodic. None of that has changed. Today's price action is not a refutation of any of it. It is a reminder that thesis and timing are different skills. Being right about the direction over 6 months does not tell you what to do at 9:45 this morning. The real skill in a session like this isn't identifying which way the market is going. It's holding 2 true things at once without letting one collapse into the other. The structural bull case for gold and silver is real, and today is a day to be short on rallies. Both statements are correct. Neither one cancels the other. That's not a contradiction. That's the job. This video is for educational purposes only and does not constitute financial advice. Every trading decision is your own responsibility. Do your own research, understand your risk tolerance, and never trade based solely on someone else's analysis.